let's welcome on board a very special guest to join us on this momentous occasion. A very watched out for and respected voice on the street, Mr. Basant Maheshwari, the author and portfolio manager for Basant Maheshwari Wealth Advisors. I don't think he needs that introduction as well. Mr. Maheshwari, thank you so much for joining us on this special occasion on ET Now. And you know what, let me start off by asking you as well that very first question. When the channel launched and you know, when you as well were invited as a guest, what's your that first memory that you know that has always stuck with you when it comes to ET Now? And also another question. Who was the very first anchor who interviewed you?
Good afternoon. I mean, first, congratulations on this 12th anniversary. I mean, my first appearance with ET Now is historic for me because that was my break into the television space. So ET Now was the first channel to have invited me, and my anchor was Nikunj. So we sat around chatting, and he said, "Kya baat karenge?" I said, anything. So he said, "What do you own?" So I said, "These are the 3-4 stocks I own." He said, "That's the best way to start. Let's talk about stocks. We'll just talk about stocks." So since then, it's been a nice friendship with Nikunj, Ajay, and Pankaj and everybody around. So that's how it's going.
So Basant, you know, just to refresh, I was in another channel that time and I saw you on ET Now.
And you
I actually called you on the very
just
same
1
day for
minute
the interview.
after this.
So that's also a very important memory.
Yeah. I remember you were at another channel and you called me just, I think, at 1 minute past this interview. I'd seen myself on TV for the first time and I was as excited as anybody would be when you see your face pop up on the television screen. So you called me just about 1 minute after that and said, "Ek program karte hain." And I was obviously very excited at that time, but that's how it went.
Right. So let's start with the market. So, you know, 12 years it's been since we launched. 12 years, they say you enter your teen and, you know, you become more, you know, matured. What would you say about the markets? The sort of, you know, move that we've had in the last 12 months. How would you say, how should an investor approach the market at these valuations? What are the things that one has to be careful because valuations by any means across various sectors have just re-rated?
So if you have to look at the market from an Indian perspective, I think this is not our teji. It's not our bull market because I would consider it to be our bull market when our banking and financial services do well. So what is doing well is our sectors and companies that are not directly related to India. So for example, one auto company is doing well, whereas Maruti is struggling because the other auto company that is doing well has got operations in China and Europe and other places. If you look at it the other way around, PSU banks are doing well, but they're doing well on another hope. What is doing well? IT is doing well. They've got nothing to do with India. Pharma is doing well. They are Indian companies with exports to US. Again, what is doing well are the metals are doing well. We have got nothing to do with metals. We just look at the price that is decided by LME or China, and then we start selling. What is doing well? Cement was doing well. It's come down a bit, but I think cement will again recover and do well because that's very, very basic and crude. And rural India would do well, but broadly, I would think it's our teji, hamari teji, jab hoegi, jab banking or financial services chalenge. So I think that's one thing to think about at the moment. So broadly, we are basically nothing. We just look at the Dow Jones, we look at the US Fed, and they tell us what to do. So we are a second derivative order of what the US market is doing. If the US Dow Jones falls 1,000 points, I don't think we are going to survive. If they go up, we are surviving on borrowed money, basically.
Mr. Maheshwari, a follow-up on that then. You know, last evening, the Fed actually showed signs of hawkishness. And they opened the doors towards finally, you know, pulling that plug on what we call as cheap money, which many say is the reason why inflation hit even 5%, the highest reading in, you know, more than a decade. Do you think some of this cheap money has also found its way towards the Indian markets? And if the Fed now is showing the very, you know, taking those very baby steps towards reining in some of that free cash, do you think that this could also perhaps put a pause on the rally that you are seeing in the Indian equity markets? Because like you said, right, this is not our tezi, this is, you know, more a global borrowed tezi, if you could call it that.
Yeah. So, I mean, the US Fed is a very mature regulatory body. So they just don't come and give you a shock at midnight. I mean, literally also. They would normally prepare you for what they are going to do. And the markets also would get prepared. So if you just see what they do is they normally send out feelers through speeches, through conversations, through interviews. So nobody gets this shock when the US Fed actually does something really strange and surprising. But what they've said is 2023, they would look at rates to go up. And 2023 is still 2 years away from here. Because the Fed has not raised rates, I don't think we would be discussing about what the Fed did on Monday or Tuesday. That had a limited shelf life, and the shelf life gets over by tomorrow. But they've shown a direction. Next 6 to 9 months, next 12 months, I think the party would last. But like all parties, this too has to come to an end. But then to look at inflation as an enemy is wrong if you are looking at inflation in isolation. If inflation comes with growth, I think the world can manage inflation. 2004, 2005 to 2008, the Fed kept raising rates, but global markets kept on going up because there was this celebration of growth and there was this new concept of emerging economies and BRICS and those kind of things. So inflation is obviously, it's a threat, it's a warning, but if you're getting growth with inflation, I think we'd take growth with inflation any day.
Well, I think it would be fair to say that we are seeing that. I mean, the last, I guess, 5 to 6 months, we are seeing a little bit of growth. We are seeing a little bit of inflation as well. So, would you say that we are in an okay spot right now? And also, for how long can liquidity as well, keep with this, bull run that we are seeing, or keep pushing stocks higher?
Globally, there is growth. India, because of the second COVID wave, and because of other factors, we are yet to reopen the economy and test the waters, if you would. But this liquidity tap will go on for a little longer than we think because, it's like cycling. You cannot stop pedaling and assume to be still moving straight on. You're going to fall. So the Fed understands this. They have inflated everything. They understand that sucking out. So right now, they're not saying they would not push in liquidity. Taper actually means the speed with which the liquidity would be pushed in would be regulated. It would come down. But I don't think the Fed would do anything to spoil the apple cart. And what I'm most interested in is after 4 years, US goes for an election. So I don't think 2023, 2024, they would like to spoil the apple cart because just like farmers are important to India, investors are important to America.
Right. You've traditionally been known to invest in NBFC and banking space. Right now, banks are not outperforming. Maybe select NBFCs that were clearly beaten down, looking at the market valuation, have started to go up. But with rates being so low, demand being so high, capex likely to pick up, how long before you think banking sector or NBFCs would do well?
Banks would do well when the economy does well. Right now, the economy is closed. We open up, but then it's going to take a lot of time. Plus, you can survive one lockdown as a small SME, as a normal middle class guy, but surviving 2 lockdowns back to back for COVID or whatever reason is not an easy task for anyone. So just to give you an example, if my factory is shut, what do? I withdraw money from my insurance, from my FDs, and I pay my laborers off and I keep the show running. What if it's asked to be shut down after 1 more year? Where do I get the extra cash from? So I think we would have to watch and see how India actually recovers back. But basic economy would do okay and fine because the government expenditure would come in. So steel, cement, and those kind of stocks would do well. But the basic economy, the SME, the MSME, I think they would take a little longer to recover. The good part is that the metals are on an upswing, which means that basically and traditionally, the domestic economy should do okay.
Right. Once when we speak about core assets, investments were not happening. Do you believe now investments will happen as metal prices have started to go up? Core economy stocks, power, oil stocks have all started to do well. What is markets trying to price in over there?
Metals are going up and commodities are going up, not because we are actually investing in core assets, because China is consuming a lot of these metals. So we get the benefit as a shareholder of metal prices. As a producer, the metal companies get the benefit when China buys metals, but the consumption is not happening in India. The consumption is happening in China. And China is actually directing the entire world. So China is on a big, big expansion spree, and we are just getting the benefits from there. But from our perspective, I think our core asset expenditure is still some time away, because I don't think right now we are in a position to actually push that pedal on. So I don't think anything is happening in India for a hurry. But yes, the metal prices that we get are an offshoot of what other countries do. Until now, it was just China who used to push metal prices. But now it's Europe as well as America. Whereas, I mean, if you would have seen, the prices of steel in America are the maximum for now. In Europe also, steel is in demand. Metals are in demand. Aluminum is in demand. So this time, it's a three-pronged demand structure: Europe, America, and China. But obviously, China is the big daddy of them all. It consumes about 50% of what the globe produces. So I think it's more about China than about America or anybody else.
So that even the rally that we have seen in metal stocks is actually more or less of an influence of global factors, China's policies, and then of course the US and Europe as well getting more generous with their spends, which in turn does lead to more expected demand for metals. So to make it, an Indian rally, Mr. Maheshwari, you said banks, financials, and those will only do well once the country sort of reboots. How far away do you think we are from that? What would be the telltale signs that would tell you that, okay, we seem to be back in action? Would the big, the most important parameter perhaps be credit growth? What would you look at as an indication that now is when you will see that pick up in banking stocks and financial stocks?
Strangely, I think the answer is vaccination. Because if we don't vaccinate enough, we're going to have another lockdown after 2, 3, 4 months. If we vaccinate faster and if we open up, I think Indians don't take time to come back. We saw it after the first wave. People had written obituaries on a number of stocks and companies and sectors and said, this is dead forever. But we recovered back. We were held back again because the second wave struck us. So I think once we open back, we're going to be again pedaling ahead with speed. But if we don't vaccinate fast enough, I mean, the third wave again haunts us. So for India, I think, but if you take a view 6 months away from now, I think things will be fine. It's just a struggling 2 quarters from here. Things will be fine because there's so much of liquidity printed in America. Most of that money has found itself into banks of emerging markets. And once you invest into banks, what do the banks do? Banks have to lend further. So it's a vicious cycle. There's a cost of holding deposit. There's a cost of holding money. So I think because of all those reasons, I think if you take a 6-month view, I think we'll be fine and okay. But by those 6 months, I assume that the Fed wouldn't destroy the apple cart. So we have to try to balance both the things, really.
But Mr. Maheshwari, even though our vaccination right now is not as much as perhaps we desire, we've not really managed to cover, a vast expanse of the population. We still have the markets at record highs. Do you think that we've already accounted and discounted for, the improved vaccination rates and, okay, that we are done with the second wave? We are perhaps ignoring the possibility, the potential as well for third wave coming by. Do you think that's the case right now then?
No, markets are on record high because Infosys is going up, Reliance is going up, TCS is going up. I mean, the top-notch private banks are going up. They've got nothing to do with what's happening back home. They are more of US operations, and Nifty is a collection of 50-odd companies, out of which 10 companies predominantly and majorly direct the move where the Nifty is going to move for the next several days or weeks. But I think our market, even in the two indices, if you remove the HDFC banks and the Kotak banks and take the second line banks, the RBL banks and the IndusInds for that matter, and remove the SBI and take the second line PSU banks, that's the real India. So you forget the top 5 banks and look at the bottom 15 banks, you will get the real India. And once that starts to fire, I would think that would be the time where we'll say, okay, India is recovering back. But for now, I think we'll wait for lockdown to open up.
Right. Let's talk about the rise of the retail investor, or so-called Robinhood investors. How would you look at that? What do you think is, making that in the market, or how essentially do you think the investment style, trading style would change because of that?
I mean, let me accept at the outset, when we don't understand anything, we say तेरे तो यार किस्मत से पैसे बन गए, ये लकी है. रॉबिन हुड ने दाम बढ़ा दिया. I mean, one of these Robin Hoods at the age of 27 would become a fund manager of some hedge fund, and he would also go and buy stocks just because he's a hedge fund manager. We'd address him with a lot more respect. So I think the Robin Hood is here to stay. They're working from home. They've got a lot of cash. The stimulus money is there. And they're driving prices. We have to fight the new Robin Hood. Earlier, it was the FIIs that used to dominate the markets. But right now, it's the retail investor. Just to give you a data point, Pankaj, I mean, if you look at the stock futures position, it was about 5 lakh contracts just before COVID. It dropped to about 1 lakh, 1.5 lakh at the depth of the problem. Right now, it's at 8.5 or 9 lakhs. So I would say that the entire retail community is trading Halo India, Halo. But another way of looking at it is, this is a predominant force now. The FIIs are normally short on stock futures right now. It's the normal retail guy who's sucking in all the cash, all the shares from them. So whatever we tell them, I mean, finally they are driving the entire car. Some of them will lose money, but today's Robin Hood is a far more smarter guy than what somebody 30 years back was. So when I was a Robin Hood 30 years back, I entered markets, I knew zero about anything. You go on Twitter and the kind of intellectual discussions that these guys do 1 year into market, 6 months into market, they have actually hastened the learning curve. So what used to take us maybe 6 years to learn, these guys are grasping it over in 6 months or 6 weeks. So some of them will lose money, but most of them, the learning curve is very high. I think they won't come back.
Right. You know, when we just talk about hard assets, how would you look at them? You know, with the US stimulus coming in, with the sort of infrastructure plans they have, with the supply issues coming in from China, what is the sense that you get? And no investments have happened into hard assets over the last 10 years. How would you look at this scenario?
So that's a very nice way of putting it. No investments have happened for the last 10 years. Hard assets could be defined in two ways. One is the precious metal, which basically is only gold. In India, we consider silver to be precious, but globally, silver is also known as an industrial commodity. So gold is forever a perpetual inflation-beating asset. So let's forget gold for a while. The secondary assets that we talk about, steel and aluminum and zinc and alloys and those things and copper, for example, there is another wave of buying happening there because of the Chinese thing. And assets prices goes up when there is inflation. That's the normal thing. But the real thing is when asset prices go up, there is inflation. So if Fed governor were to say that inflation is higher in 2021, we are comparing 2021 to 2020. Obviously, it's a statistical comparison. So obviously, asset prices are high. So if you're assuming inflation to be higher in 2022, you assume all these commodities to be going up even further up from here. Because if you assume zinc prices to be coming down and lead to be coming down and copper to be coming down, there would be no inflation and there's no problem anywhere. But if the government, if the Fed governor thinks that there would be inflation in 2022, it's good news for the commodity manufacturer, for the ore digger. Here you have to understand that the normal retail guy, if he's bullish on copper, he should be looking at companies that have copper mines, not companies that are just converters. So if there is inflation, commodity prices do well, at least in times of an industrial recovery. If you have a 20-year view, then gold will do well for inflation. If you have a 3-year view, I think these base metals, the ferrous metals and the non-ferrous will do well.
So overall, what's your view on all the names associated with Indian infrastructure? You know, be it power, be it cement. I know you shared your view on metals, so you know I'll talk about the other names, the other ancillary names. You know, road building, infra. I think infra has been almost like a dead sector for the most part of the last decade. The last bull run was more than a decade ago. We've been waiting ever since then that, you know, okay, this will be the trigger. Oh, that, you know, higher government spending, larger fiscal deficit, all those macro indicators, but not really much has worked out. perhaps owing to the fact that, of course, you know, we had the whole IBC cases as well that increased in number, so on and so forth. How would you play all of these names then? Do you think that, you know, these could show some promise?
Amina, most of the infra companies are stuck at the NCLT, then on the ground road doing some infra work, except for the top-notch ones. Same with the real estate. You need organizations to go around and do that work. So they were so much into debt and they got into this BOT scheme because they just could not tell investors that there is no growth. So they converted a capex site model into a capital intensive BOT model, that most of them don't have the working capital and the available funds to deal with the present kind of a situation. And when steel prices and metal prices and zinc prices are in such an upswing, I mean, I think the infra companies would be thinking twice before bidding for an order. Of course, there's an escalation clause and things like that. But I think in India, infra, the hard infra would still do well, the airports and the port types. But apart from that, I mean, I'm talking about the business per se, not about companies at all over here. But apart from that, the real road construction, the real making of flyovers and bridges and all of those things, I think the government has to take the first move forward. If the private sector follows good enough, that's what mixed economy is all about. The government gets into places where the private sector doesn't want to get in. Because I think the private sector right now is too scared and they don't have all the cash to do all the work. So except for the top-notch L&Ts and a few ones here and there, most of the infra companies are struggling. So if you look at the infra stocks that are going up, most of them are going up. One of them is going up because it's just come out of NCLT. So that's not a great space for the country to be in, but that's how it is.
Okay, well, Mr. Maheshwari, just before we let you go, consider it as our 12th anniversary gift. But what are the sectors then at this juncture that you'd consider yourself overweight on?
We are overweight on metals, completely overweight. We are obese on metals, I could say. But for the guy around there who's hearing us, if you want a 5-year, 10-year view, look for the best insurance company and buy the stock and don't push too much head on it, because these are stocks where you will make money year on year. Your speed would be slow, but always think about the race between the tortoise and the rabbit. So don't try and become the rabbit. Tortoise is good enough in this market. Surviving is winning.